Hey everyone! And welcome back to the channel. Today, we're diving deep into a topic that's on everyone's mind, the US housing market. For months, we've been hearing whispers, and even some outright shouts, about potential interest rate cuts from the Federal Reserve. The logic seems simple, right? Lower rates should make mortgages cheaper, which should then light a fire under the housing market, helping it recover. But as we're starting to see, the reality is a lot more complicated. The housing market isn't just sluggish, it's stubbornly resisting the usual remedies. And today, we're going to unpack exactly why. Let's start with the big picture. The Federal Reserve, in its fight against inflation, hiked interest rates at a historic pace. This had the intended effect of cooling down a red-hot economy, but it also slammed the brakes on the housing market. Mortgage rates soared, pushing many potential buyers to the sidelines. Now, with inflation showing signs of easing, the Fed is signaling that rate cuts could be on the horizon. Naturally, this has created a lot of optimism. Home builders, real estate agents, and aspiring homeowners are all looking at this as the light at the end of the tunnel. But here's the first major roadblock: the lock-in effect. Imagine you're a homeowner who bought or refinanced your home back in 2020 or 2021. You're probably sitting on a mortgage with an interest rate of 3% or even lower. Now, fast forward to today. Even if current rates drop from around 7% to, say, 6% or 5.5%, are you really going to sell your home and buy a new one? Probably not. You'd be trading in your ultra-low rate for one that's nearly double. This financial disincentive is keeping millions of homeowners locked into their current properties, even if they've outgrown them or want to move for a new job. The result, a severe shortage of existing homes for sale. Inventory is trickling, not flowing, onto the market. So, even if rate cuts bring more buyers into the game, there are simply not enough houses for them to buy. This scarcity is a huge factor keeping the market stagnant. This brings us to our second point: affordability, or rather, the lack of it. The price of homes skyrocketed during the pandemic boom. While prices have cooled off slightly in some areas, they haven't crashed. In fact, in many desirable locations, they're still climbing, albeit at a slower pace. The fundamental problem is that home prices have outpaced wage growth for years. So, even if mortgage rates come down a little, the entry fee, the price of the house itself remains astronomically high for the average American family. A slight reduction in the monthly mortgage payment from a rate cut doesn't magically make a $500,000 house affordable for someone earning the median income. The down payment, closing costs, property taxes, and insurance are all based on that high sale price. The math just doesn't work for a huge portion of the population, and a small rate cut isn't enough to change that fundamental equation. Now, let's talk about the new construction side of things. You might think, okay, if there aren't enough existing homes, why don't we just build more? And home builders are trying. We've seen an uptick in housing starts and builder confidence. They are the ones who stand to benefit most directly from lower rates, as it helps them with their own financing costs and makes their new products more attractive to buyers. Many builders are even offering their own incentives, like mortgage rate buydowns, to lure customers. However, they are facing their own set of serious challenges. The cost of building a new home is still incredibly high. Material costs, from lumber to concrete, remain elevated. There's also a persistent labor shortage in the construction industry, which drives up wages and extends project timelines. And let's not forget about land. The price of well-located buildable land is at a premium, and navigating the web of zoning laws and regulations can add months, or even years, and significant cost to any new development. So while builders are adding some supply, they can't build fast enough or cheaply enough to solve the nationwide shortage and affordability crisis. They are building for the higher end of the market because that's where the profit margins are, leaving a massive gap for starter and middle-income homes. Another crucial angle to consider is consumer psychology. The last couple of years have been a roller coaster. We've seen economic uncertainty, inflation, and layoffs in some major sectors. This makes people cautious. Buying a home is the single largest financial decision most people will ever make. Even if the numbers on a mortgage calculator start to look a little better, buyers might still hesitate. Are we heading for a recession? Is my job secure? What if I buy now and prices drop later? This fear and uncertainty can be a powerful brake on the market. Independent of what the Federal Reserve does, consumer confidence needs to fully recover before we see a flood of buyers rushing back in. And that's a slow and gradual process. Let's also touch on the regional differences. The United States isn't one single housing market. It's thousands of local ones. A potential rate cut might have a more noticeable effect in more affordable markets in the Midwest or the South, where the price-to-income ratios are less skewed. In these places, a drop in mortgage rates could be the nudge that buyers need. However, in the hyper-expensive coastal markets like California or the Northeast, a half-point or even a full-point rate cut is just a drop in the ocean. The affordability gap is so massive that it will take much more than a modest policy tweak from the Fed to make a real difference. We're seeing this play out already, with some markets remaining hot, while others are decidedly cool. This fragmentation is likely to continue. So, where does this leave us? The prospect of Fed rate cuts is a positive signal. No doubt, it's a step in the right direction. It will likely prevent a further decline in the housing market and might provide a modest boost to activity. We could see a slight increase in sales volume as some buyers on the margin are finally able to qualify. However, it's crucial to manage our expectations. These rate cuts are not a silver bullet. They won't magically solve the deep, structural problems plaguing the U.S. housing market. The chronic undersupply of homes, the lock-in effect keeping existing inventory off the market, and the fundamental crisis of affordability are powerful headwinds that won't disappear overnight. The path to a truly healthy and balanced housing market is going to be a long one. It will require a multifaceted approach that goes far beyond the Federal Reserve's monetary policy. We need policies that encourage the construction of more homes, especially smaller, more affordable starter homes. We need to address restrictive zoning laws and streamline the approval process for new developments. And on a broader economic scale, we need wage growth to catch up to the cost of living. For anyone out there trying to navigate this market, whether you're a buyer, a seller, or just watching from the sidelines, the key takeaway is this: be patient and be informed. Don't expect a sudden boom or crash. The housing market is likely to thaw, not boil, in the coming year. The recovery will be slow, uneven, and at times, frustrating. The rate cuts will help, but they are just one piece of a very large and very complex puzzle. What are your thoughts on this? Are you seeing these trends in your local market? Are you a homeowner, locked in by a low rate, or a buyer, waiting for the right moment? Let me know down in the comments. I read every single one. Thanks so much for watching today. If you found this breakdown helpful, be sure to hit that like button and subscribe for more in-depth analysis. We'll see you in the next one.